We just heard the news last week. The BLS just said that we've lost more than 911,000 jobs more than we expected. Or in other words, there's 911,000 less jobs that had been created than they originally thought. This is a big deal, not just because feds are talking about cutting interest rates today as we talk about this recording, but it's also going to lead to something much bigger that might affect your pocketbook more than you realize. And that's what we're going to talk about today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you if you want to create enough passive income to become work optional, where you work because you want to, not because you have to, where you have enough passive income that's able to let your money work harder for you so you don't have to work so hard for that money, giving you that freedom, that time freedom, that money freedom to be able to do what you love with those you love. But most importantly, it's not just for you to get rich, although that's a great perk too. It's so that you can live a rich life, because as you're blessed financially, as you have greater capacity, greater financial means and resources, you can now create a greater ripple effect through the lives of others. And that is what it means to be a Rippler. And a special shout out to you guys. Anyone who's here doing this today, you're here because you want not just freedom for yourself, but you're really here because you want to serve more people. You want to be able to make the world better because you're in it. That is exactly what I'm talking today. So a special shout out to you, especially some of you guys have been faithful listeners, been binging and sharing these episodes. Thank you so much for doing so. Hey, as a reminder, our book, Work Optional Blueprint, the pre-launch is about to happen soon, very soon. In fact, probably about the next week from the time you see this. So be aware, make sure you're on our list. Be sure you go to our website, moneyripples.com, for more information to know how you can get your hands on that book right away. All right, so let's talk about this right now. Let's talk about the whole 911,000 jobs that were supposedly not created after the government said they were created. Now, this should be not a shock to you, especially if you've been following us for a while. I've talked about how a lot of this data has been manipulated. We know that inflation numbers have been manipulated. We know that employment data has been manipulated, and not just manipulated in a sense, but just done so inaccurately. Let me just give you some background here. The way that they've been doing the jobs report, right, to figure out what happened last month, how many jobs are created or lost, which almost all the time you always hear about them being created. It's always been based on they call it the birth-death concept, right? Where what companies have been started, how many people they employ, versus what companies went out of business and how many jobs are lost. It's a very rudimentary thing, because the truth is there's jobs made and lost much more often inside those extremes, right? With companies that didn't come into business or go out of business during that period of time. And so they make these estimates. It's really very much like I've quoted before from Robin Hood Men in Tights, Blinken, the blind guy up on the watchtower saying, I'm guessing no one's coming. They literally have been guessing, which is why Trump fired the advisor. And that's controversial and debatable in and of itself. In fact, in the comments, let me know if you think this is a smart move or not. I have mixed feelings about it, maybe like many of you do too. But regardless, we just had this revision go down. Let me show you what I'm talking about, because this revision is not just saying, oh, okay, we've lost some jobs. No, this is a big deal, and here's why. All right, now what's so important to understand here is this is just based on the actual job revisions just from the last year, going from March of 2024 to March of 2025. This does not include a lot of the AI talk about AI taking jobs. This does not include any effects from tariffs. These are literally everything that's happened pretty much during the Biden administration. Now, I know there's gonna be a lot of mudslung, I guess that's a word, slung on Biden and his administration for all this stuff. And, you can argue that for sure. Now, what's gonna happen with Trump should be more concerning. I'm gonna show you why in just a few minutes here. But here's the revision, right? Here's the kind of the chart revision. We're showing it way higher up there towards 5 million in 2023. Now, what was happening before this? Let's take a look. Now, before this is coming from all the way back to 2015. These are the revision to the monthly reports, right? Now, up till what you'll notice is this. Usually when there's a big boom time, the revisions go upward. When there's not a boom time, they go downward. Notice, like 2019, there was a lot of negative revisions. This one right there, I mean, freaking like 100% revision to the downside. So double, right? Definitely a lot more revision to the downside on that end. And then of course we had 2020. Now things were kind of flat, right? Because the truth is there were a lot of death jobs and layoffs and things like that, or furloughs. So there's a lot of freezing happening. But notice once we got into about 2021, The revisions went higher because, of course, people started hiring again in the companies that already existed. So now we saw the numbers way better when they revised them. Everything looked stronger. Things look great. Now we saw a little bit of revisions there in 2022. We see that. We also saw the stock market drop in 2022. But notice what happens from 2023 onward. Now notice the revisions from March 2023. This is important to know because that last chart I just showed you right here, right? This shows you the revisions, but it doesn't show you that this was also a revised number as well of these job creations. So these numbers have been coming down, but they were already revised back the previous year, and they were negatively done so. So about 598,000 jobs were revised from March of 2023 to March of 2024, right? There was about 600,000 jobs there. Now it's revised down 911,000. That means in the previous 2 years, they had overestimated job creation by 1.5 million jobs. That's no small number. And so that's what we're showing right here. When I show you this chart, notice like when we go into 2023, we start to see more revisions. Now there's a nice up one right there. Cool. There's some ups and then there's downs. Even going into 2024, notice how much more negative the revisions have been going into 2025, even before March 2024, even January, February. That was revised from the previous revision that they did last year that shocked people because they said that we didn't expect 600,000. By the way, economists are expecting anywhere from 400,000 to 1 million jobs, and it was much on the lower end. We saw that go down a lot more. So what we're seeing right here is we've seen massive job revisions. The numbers have been way off. This is the big point you want to remember. We haven't revised anything past March. Now, there's been some revisions for June, right? And actually, you'll see this. If I go back to this chart, you'll see June 2025 right here. Notice it was a big revision right there, right? Down 90%. That wasn't from this big report that just came out last week. This was from just a few weeks prior when they said, hey, we revised July and here's June. So here's actually June's numbers. And they said they're lower than we thought. That's where it lead to today, right? Here's what we're seeing. So remember, there's May, there's June, right? They said they actually revised it. And so we actually lost 13,000 jobs in June. This is what sparked Trump to say we need to replace this person. And they're not collecting data the right way. By the way, the person they replaced really won't help with the data collection. Maybe they make an overhaul in the system. So notice this is before we had the revision from April 2024 all the way through March of 2025. So these numbers are all worse in this section right here. They've already been lower. Notice the trending pattern, less and less job creation. Now we're even starting to see job losses. They haven't revised these numbers yet. These aren't even accurate numbers. They're just the second revision, the third revision, the big revision they do when they do a whole year's worth. That's the big one we want to look at. And guess what? If we're already at the point where there's hardly any job creations, what do you think that revision is going to look like? Do you think it'll stay positive, or do you think we'll actually see job revisions into the negative, an actual net job loss? Therefore, unemployment going up, which we know unemployment numbers aren't very accurate either, right? They also do some things to make it look better, especially for political reasons, and among many other things. So what are we seeing right now? What does that mean for you? Okay, this is what it means. Now, I'll show you one more chart. Now, let's talk about mortgage rates and the Fed rates and everything that we're having an announcement today. I am recording this over a week before the actual Fed rate. So I'm recording this over a week ago. So I'm projecting. Now, I've been predicting this all year that rates weren't coming down anytime soon. So so many people thinking there's going to be like 4 rate cuts in the year of 2025. I call bull on that. Why? Because I've been watching this. If I even go longer than this, right? So I've been watching the actual 10-year Treasury yield, right? Now, last year we were seeing it go lower. We did see rates drop because they were following the rates. Feds follow this rate, right? They don't follow like their own devices thinking like they're just going to use this economic data. They do consider it, but they're watching what's going on here. If these rates don't come down, they don't drop rates. And so what happened is, we started to see it climb back up in 2024. This is what and even in the early 2025 this year, this is why I said, don't expect rates to drop. And they haven't, right? They didn't drop. Now we have seen a gradual drop. So even leading up to this, before the announcement about the BLS and everything else, and just what's been going on the last week, which has been showing weaker and weaker data, I've been saying that, we might finally see a rate cut in September, but it'll only be 0.25%. I think they could actually potentially drop it 0.5%. especially if they look at these numbers from the BLS and say, wait a minute, if we've already seen job creation going barely flatlining, does this mean that when we revise this data that we're actually seeing a job loss? What's the unemployment doing? We still haven't seen the full effects of tariffs. I still think they're going to hold them up higher than what people want. This does not mean they're going to come crashing down. If they come crashing down, that's a whole nother story. But what we're seeing right now is that we could see potentially, I might be wrong from previous predictions when I said 0.25% only, even though some people were calling for 0.5%. I think 0.5% is possible for today's release. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. Yet, that being said, we don't know. We don't know what the feds are going to do with the federal funds rate. If they're going to drop it. I know they're going to drop it. It'll be at least 0.25%, maybe 0.5%. Regardless, what does that mean for your mortgage rates? Not much. So this will mean if you have a home equity line of credit, this does give you some breathing room, right? This gives you a little bit more breathing because you're going to watch your interest rate and your payment drop on a home equity line of credit. This might even affect your credit card rates. Again, not much, right? This will also potentially affect your savings account rates, which will also potentially go down even more than what they are right now. This is why infinite banking is so much of a safer place to be, because it's much more of a lag and they go off of more treasury yields and things like that, which are still pretty high. We're still over 4% as of this September 9th when I'm recording this, even though we're releasing this next week at the Fed's announcement. Hardest to try to keep up to date with you guys here. So I do think the rates will go down if and only if we see this rate stay down. So if it stays down around 4% or even drops below 4%, yes, we'll see it drop. However, your mortgage rates, your 30-year mortgage is not going to drop much. Yes, there is some correlation to this and 30-year mortgage rates, but you're not going to see a lot of relief yet. You're going to see a little bit. I mean, you might see it drop 0.25%, but you're not going to see a huge amount of relief, not to the point where people will really want to start buying again. However, if there's any fear, this is what will happen. If there's any fear that rates won't go down much more, maybe they could go back up if the Fed say we might raise rates again, or, which may or may not happen depending on inflation numbers and all that kind of stuff. If they do think that, and by the way, inflation numbers, they are paying attention, but they're really paying attention to these rates. These are the rates that determine what the Feds do. That's the one thing that most people don't realize. And so, yeah, they could be saying we could still watch it stay the same, or maybe we'll watch it go up if there's any threats of inflation. They might leave that door open, right? However, I think what we're seeing here are the cracks in the economic system, which could also lead to cracks in the stock market. Just so you know, we need to see a full percent reduction. We got to see like 30-year rates go below 6%. Before I think people really start to buy again. But what happens if those rates do drop? Say you can get a 30-year mortgage for like 5.75% or 5.5%, which would feel amazing for people. I know I'd be talking to people about potentially refinancing right now, or looking to buy a home. Might do it now because you can at least lock in the rate, and if they go down more, you can always refinance again, right? Well, if it doesn't get into the fives, it won't matter. We won't see much. But if it does go into the fives, we will see home prices once again start to escalate. This is why if you start to see something like this happening, this could be the best time to buy real estate. When, by the way, nobody says you should be buying real estate right now. They're actually telling you, oh, it's a horrible time to buy real estate, which is exactly when it could be the best time. Now you might say, well, I'll wait for rates to drop. This is the risk you run. If you wait for rates to drop, you might lose, because when those rates drop, guess what? Everybody else is thinking the same thing. You're too late to the party. You're following the lemmings. Your best advice would be, if I could, buy the real estate now, and then if rates do drop, I can always refinance later. There are many mortgage companies, especially right now because they have been suffering, that say we'll do a simple rate recast, right? Like a rate refinance at no cost. They'll give you a no-cost refinance later down the road if rates do drop. So you might be able to take advantage. Now, the cash flow may or may not make sense. Yes, I get it. On rentals, if the rates are where they are right now, you might have to buy down the rate anyways. Okay, got it. You might have to buy down the rate just to keep it in a profitable place. But again, because if rates do drop, expect real estate to start heading back up again. Real estate's been pretty flatlined the last year or so. Some areas it's gone up pretty well, others it's gone down, and some areas it's just been flat. We really haven't seen a lot nationwide happening on the rate side, but we're still seeing those rates climb because again, home builders aren't building because there's not the demand because people don't want to have those high interest rates, and people aren't selling their homes, they're staying in their homes. So people are stuck. Have you noticed this? And this is important. This stuck energy is exactly what's keeping you stuck financially. Do you find yourself saying, I'm just going to wait and see? If you're in the camp of wait and see, you'll find out that you'll wait and see your money deplete. You will wait and see your stock market funds deplete. You'll wait and see that you've missed opportunities that you could have got in and say, I wish I could have. The shoulda, woulda, coulda crap would be coming out left and right, all because you said, I'm going to wait and see. This is the worst time to wait and see. And I know I sound like a robot when I say this, but it's true. You got to be careful not to be that person, to be just wait and see. Now, I'm not saying there won't be future opportunities even after that point, but right now, when nobody wants to buy, is the perfect time to buy. Right now, everybody's buying stocks. Everybody's loading money up in there, thinking that's going to be fine. People are starting to load money into their digital currency again. People are now starting going to gold and silver, and watch what's happened with that, right? People have already been going that direction. If you start to follow them, you're going to find out you will make very little money and possibly be put into a place where you've been over in this bubble, this balloon. The stock market's already been there. Here's the thing. If you expect rates to drop more, the only reason that you'll see rates drop more is because there's something way worse. So be careful. If you see the Fed saying we need to lower it 0.5%, if you even see them, now I don't think they'll do this, but if they say we're going to lower it 0.75%, you know they're panicking. They're going to panic because they know something is going wrong. Then, even though that would be normally good news for everybody else, is bad news if you're in the stock market. Bad news because they believe that there's huge cracks. In fact, look at this, the economic data we've been looking at, you might be saying, wait a minute, this looks a little like a recession. You know, well, GDP numbers have been this way. Yeah, but remember, GDP numbers, a lot of it's based on government spending. And even though Trump came in with his whole Doge thing, there's still a lot of government spending happening on his end too, right? So even though they're trying to cut costs, they're also increasing costs in other areas. So they're really not cutting government spending, which is a lot of GDP data. What happens when we actually have to really cut spending, have to balance a budget, like Clinton said years ago, right? When he came in, that could actually slow down the economy a lot. So, and I think personally, I believe this is that it's already been slowing down. The reason why you're not seeing more job creation is because companies, and I'm seeing it in my own company too. It's not that we're going under, but we're being very careful and we're trying to figure out, hey, how can we use AI to be more efficient? Can we be more profitable that way versus hiring more people? Well, the problem is this. If we're not hiring more people, or even worse, there's jobs being lost, companies going out of business anyways, right? And people are now looking for new places to work, but they can't. And I've seen this more and more all the time, even among our own clients. If this is starting to happen, that means they've got less money to spend. And if they have less money to spend, guess what? That means less people are getting paid and the companies still suffer. So even though this AI tech boom can create a lot of good things, and we're using it in our company too, on the flip side, especially when it comes to the jobs, right? This should be a number one concern. And with the tariffs being, creating potentially more expenses for companies anyways, where they have to cut costs, this could give them the impetus, the push to want to use more technology, more systems and things in place that replace people. Now, I don't think people will be completely replaced by AI or anything like that. I do not believe that at all. There's so much value in people. We're hiring more people, even in our own company, even when a lot of people are talking about not hiring people or even cutting jobs. But we're doing the opposite, right? We're starting to do the opposite because we see the opportunity. A lot of great talent is out there, but unfortunately, a lot of companies are finding less and less wiggle room. Just like people are in their personal finances, feeling like there's more and more of a pinch on their finances because of inflation, companies are feeling it too. We've had to go through it. We've had to figure out ways to cut costs and be more efficient to ensure that we can actually keep growing and expanding. But a lot of companies aren't able to adjust very quickly. Small companies, small businesses, which most of Americans are hired by our small businesses, aren't always being that diligent with their numbers. So just be aware. And even if they are diligent, again, just things can happen in industry that can slow things down or get it down to a creep or a crawl. This could be affecting you. Again, if money isn't changing hands quickly, which it seems like things are slowing down, That could actually really be, if we haven't already been in a recession, like a very quiet recession, kind of like Japan was from the 1990s through the 2020s. They had about a 25-year recession. This could also be affecting us too, right? Japan's just coming out of the recession. What if we go into this slow creep? Remember the whole soft landing the Feds were trying to do? What if it's leading us not to a soft landing, but a soft crashing? And then we crash longer and we're in a deeper, longer recession was originally planned. That, that is what you should be watching out for. That alone should make you think, should I be keeping my money to wait and see to see what's going to happen with my money? Or should I be making money moves right now to protect it first and foremost? And secondly, then knowing where to invest it for greater opportunity when other people aren't doing the same. Everybody's been doing the same crap and everybody's been sitting put. This is the time the most intelligent people are going to say, now is the time to make a change. And we've already seen it. We've seen a lot of our clients doing this already. People are already making these moves. Big money, institutional money has already been making these moves. So why aren't you? Oh, I want to wait and see what other people do. Oh, yeah. When has that worked out? When have the masses made great, wealthy decisions? Like never, never have the masses made great, wealthy decisions. They've always been too late to the party and they feel like they're the victims to what wealthy people are doing. No, it's about educated versus ignorance. Do you want to be educated or ignorant? That's the key. Ignorance is not bliss. Ignorance is expensive. Education, that having the right training and the right knowledge and the right connections and relationships, that is an investment worthwhile. That is an investment that can pay you literally millions upon millions of dollars if you do it right. So anyways, I'm going to leave it at that. Let's see what the Feds do, of course. I would love to see in your comments what you think is going to happen. Please let us know. And of course, if you have more questions for us, and maybe you're saying, I want to make a move today, reach out to us at moneyripples.com, book a call, see what you could be doing right now that might actually not just save you from hundreds of thousands of dollars of losses, but could actually create hundreds of thousands, if not millions of dollars of gains as a result of being early versus being late to the party. So guys, go and make it a wonderful and prosperous week. We'll see you later.